Here's a quick snapshot to help you jumpstart your SIP journey. What is an SIP? A systematic investment plan, or SIP, is a smart and hassle-free tool for investing in mutual funds. It is similar to a recurring deposit where you save a fixed amount regularly for a period of time. The difference is that with SIP, you invest a fixed amount regularly in mutual fund schemes. These schemes have the potential to beat inflation and create wealth for you in the long run. Why invest through SIP? Power of compounding. An SIP, which continues for a longer period, helps you to harness the power of compounding. Small amounts invested keep adding up to create a large amount of money. Do you know that by just investing rupees 5,000 per month from the age of 25, you can create a wealth of approximately 3.2 crore rupees by the time you retire? That's the power of compounding. You can start small. You don't need to wait till you have a large amount to invest. Through SIPs, you can start with an amount as small as 500 rupees a month. You get flexibility. SIP gives you the flexibility to choose the amount you want to invest, the frequency of investing, the scheme you want to invest in, and the time you want the SIP to continue. You can invest either daily, monthly, or quarterly in the scheme of your choice based on your preference. No need to time the market. With SIP, you invest regularly in mutual fund schemes, irrespective of market ups and downs. As a result, the cost of purchase is averaged out over a period of time, and you don't need to worry about timing the market. It is very convenient. Investing through SIP is very convenient. The amount you choose is auto-debited from your bank account at the pre-decided frequency. So you do not need to worry about how to invest every month, which in turn helps you instill financial discipline. Thus, SIP helps investors get the benefit of compounding and can build wealth in the long term. How to start an SIP? To start an SIP, you first need to get your KYC done. You can either speak to a financial advisor, walk into an investor service center, contact registrar and transfer agents like CAMS or Karvy, or visit any of the online platforms. You need the following documents with you: ID proof, address proof, one passport size photograph, and a cancelled check. This gets you mutual fund ready. Then you can select a scheme that suits your investment objectives and risk profile. After this, you just need to decide on the amount, frequency, and time period of investment. Finally, you start your SIP, wherein a fixed amount, as decided by you, is invested in the fund of your choice from your bank account. And yes, you can also stop the SIP anytime you want. There are no penalty or charges to stop. In the long run, SIP investments can help you fulfill the big dreams of your life by starting small with SIP. Start investing today. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Power of compounding. Have you ever wondered how a small initiative of yours can create a multiplier effect in your life? Let me take you to the world of Mr. Sagar. While returning home one day, Mr. Sagar came across some mango tree saplings being sold at the market. So he bought one, thinking it would be nice to have a mango tree in his backyard. The next morning, Mr. Sagar planted the mango sapling in his backyard, not aware of the magical consequences of his actions. He watered the soil around it, full of hope that the plant would start to grow and bear fruits very soon. Weeks and months passed by. In the meantime, Mr. Sagar would nurture the plant on a regular basis, water them, prune unwanted twigs, and use good quality fertilizers. Slowly, the plant started growing into a tree. But even after 3 years, the mango tree did not bear any fruit or flower. On top of this, after 5 years, there was a huge storm one day, and due to such bad weather, the tree became very weak, shedding a lot of its leaves. But keeping his faith on, he kept nurturing the tree and the tree kept growing bigger. 7 years later, one day he noticed that the tree had started bearing some flowers. Slowly, those flowers turned into fruits. At the end of 10 years, the tree was fully grown, bearing a lot of fruits and flowers. A happy Mr. Sagar, along with his family, shared this bounty with their relatives and friends. Hence, Mr. Sagar's patience finally paid off. Investments also work in a similar manner, where patience is the key. Do not get disheartened or panic if you do not get the expected returns from your investments in short or medium term, that is 3 to 5 years. Be patient and you would start reaping the benefits through the power of compounding, which can help your investment grow into a substantially bigger corpus in the long term. Start investing in mutual fund schemes today. Reach out to your financial advisor to know more. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Behavioral biases are preconceived notions or prejudices that often lead investors to make emotional and irrational decisions when it comes to investing. Let us understand how behavioral biases can get in the way of sound financial decisions. Meet Arjun, who is 35 years old and wants to make smart investment decisions. He is a strong supporter of the equity market and decides to invest some money in equity mutual funds. He scans through a few newspapers to find out the most popular equity funds in the market and invests in one of them. This is attention bias. In this bias, investors tend to invest in financial products which are frequently highlighted, say in newspapers, news channels, without analyzing their suitability any further. The next day, Arjun meets his colleagues Naveen and Vinita over a coffee break. They start discussing on various investment options to build a retirement corpus. Naveen puts forward his belief of investing in safer avenues like debt funds and fixed deposits. Arjun, however, emphasizes on the potential of superior returns of the equity market. Vinita, being a strong supporter of safer investments herself, ignores Arjun's opinions and focuses only on what Naveen says. Here, Vinita exhibits confirmation bias. In this bias, investors tend to seek out only those information or opinions that support their preconceived notions about investments. They tend to turn a blind eye towards information that does not support their opinions. Undeterred by the conversation, Arjun decides to invest some money in another equity fund. He does a quick scan of the last quarter returns for the mid-cap equity funds and invests in a fund which has performed spectacularly in the last quarter. Here comes our next bias: recency bias. In this bias, investors tend to invest in instruments which have only performed well in the recent past, without considering their long-term performances or other factors. Naveen, unlike Arjun and Vinita, is in his 40s. He is confident in his ability to build a substantial retirement corpus, even if he starts investing when he's closer to his retirement. He is very optimistic that he would be able to build an adequate corpus to lead a comfortable retirement life. Now, this can be construed as optimism bias. In this bias, investors tend to be overtly positive about their finances, with or without substantial actions or information to support the outlook. The next day, Arjun, Vinita and Naveen go to an office party. During the party, Arjun gets to know about a stock in which many of his colleagues had invested and who were of the opinion that the stock has a huge growth potential. Arjun, not wanting to miss out on a good opportunity, goes home and invests in the stock. This is herd mentality. In situations like these, investors tend to follow market trends blindly. They invest owing to the fear of being left out, without checking the relevance of these investments with their financial goals. Now, Naveen, who was also at the party, was having a discussion about the performance of a stock. He had invested in the stock around 5 years ago, but the stock had not been performing well for the last 3 years. Also, during his discussion, the fact that the future outlook of the company may not be very promising came out strongly. Yet, Naveen was not comfortable redeeming his investment, as he hoped that the company would recover soon. Here, Naveen exhibits loss aversion. In this bias, investors tend to hold on to unprofitable investments or invest in instruments having low return potential, just to avoid realizing a loss. So how do we as investors keep these behavioral biases from undermining our investment decisions? By following 3 steps. Recognize and acknowledge that these biases exist. Understand how these biases can affect our decision-making process while investing. Understand whether our investment decisions are done objectively. That is, they are based on factual data and not emotional responses. Adopt strategies to make investment decisions free from bias. For example, plan asset allocation before investing. Review and rebalance portfolios periodically. Take help from professional advisors, and so on. Eliminate subjectivity and make investment decisions emotion-free. Happy investing! Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. You must have heard of SIP. But are you confused about what it really means and how do you start it? Here's a quick snapshot to help you jumpstart your SIP journey. What is an SIP? A systematic investment plan, or SIP, is a smart and hassle-free tool for investing in mutual funds. It is similar to a recurring deposit where you save a fixed amount regularly for a period of time. The difference is that with SIP, you invest a fixed amount regularly in mutual fund schemes. These schemes have the potential to beat inflation and create wealth for you in the long run. Why invest through SIP? Power of compounding. An SIP, which continues for a longer period, helps you to harness the power of compounding. Small amounts invested keep adding up to create a large amount of money. Do you know that by just investing rupees 5,000 per month from the age of 25, you can create a wealth of approximately 3.2 crore rupees by the time you retire? That's the power of compounding. You can start small. You don't need to wait till you have a large amount to invest. Through SIPs, you can start with an amount as small as 500 rupees a month. You get flexibility. SIP gives you the flexibility to choose the amount you want to invest, the frequency of investing, the scheme you want to invest in, and the time you want the SIP to continue. You can invest either daily, monthly, or quarterly in the scheme of your choice based on your preference. No need to time the market. With SIP, you invest regularly in mutual fund schemes, irrespective of market ups and downs. As a result, the cost of purchase is averaged out over a period of time, and you don't need to worry about timing the market. It is very convenient. Investing through SIP is very convenient. The amount you choose is auto-debited from your bank account at the pre-decided frequency. So you do not need to worry about how to invest every month, which in turn helps you instill financial discipline. Thus, SIP helps investors
Yeah. Thank you, operator. Good afternoon and a warm welcome to all the participants of the call. Thank you for having accepted our invite and taken time out to come for this webinar. I hope you'll understand that we are starting now about at 4:08. While we have mentioned 4 p.m. as a point, we were just looking at all the people who were logging in, and it took us time to ensure that all the interested participants log in and connect, and then we start the call. For today's webinar, we have Mr. Gopal Agarwal, Senior Fund Manager, Equity, to take us through views on the markets and also fund positioning of growth opportunities and Focus 30 fund, which he is managing. I'm sure that all of you will quite agree that markets have surprised this year and in the recent times significantly on the positive side in the way the markets have been performing. And I'm sure this is also just 6 months back, we had the concerns from investors as to what would happen to the market in terms of how much loss they should protect. And here now we are talking about the other side of it. So with such kind of changes, it is very quite important that we get the fund manager's view on what we should probably speak with our customers going forward. I request Gopal Agarwal to share his thoughts, views, and also the fund positioning of the funds that he's managing. Gopal, thank you for your time. Please join the meeting, and you may please start. Over to you, please.
Sure. Yeah. Good afternoon, everyone. I am Gopal here, and I welcome you all on behalf of HDFC Mutual Fund. So today I'll just share some perspective on the markets, and then I'll take the product. So first of all, the market is really, I would really agree with the words used by Srikant that market has really surprised everyone. But honestly speaking, I was really confident that the levels which we saw because of COVID was very short term. But definitely, I had not expected the kind of bounce back. So I was very positive on the market that point of time. So very clearly, the few things which are really helping the market. One is that we are in a very low and benign interest rate scenario. Today, as you all know, that today reverse repo is the operating rate, and we have highest ever forex is above over $561 billion. And second point is that globally we have very low liquidity, very low interest rate scenario, and very high liquidity. So the liquidity is supporting everywhere. The third point is that we are seeing some recovery in Indian economy post September, and in October things are really very encouraging in terms of GST collection, the traffic movement, the power generation, the e-wage bill generation, automobile sales are really encouraging. Though I would not say that we have come across and everything is normal. Definitely, there are still uncertainties about the COVID and its impact, but very recently, the data on the vaccine, shown by Pfizer is very encouraging, and similarly, AstraZeneca is also progressing well. So, I think things are moving in the right direction. Add to this, for all the people who have surprised very positively is by the quarterly result of Q2. Q2 results were so encouraging. I will tell you that for the last 2-3 years we have never seen such a result season which has really beaten the street estimate very handsomely, and it has beaten qualitatively. In this result season, I can tell you what has worked very favorably to the companies is that in the March, April, we saw the oil prices going to minus and then adjusting to $20. So everybody had a benefit of lower benign input prices. Second is that we had very low marketing effort, promotional expenses, tours and travel by the company. So this has led to, on an average basis, 3% reduction in other expenditure by the various corporates reported result. So 1% benefit on the raw material side, 3% almost benefit has come on the other expenditure side. So net 4% benefit to the margin on an aggregate basis. In some companies more, in some company less, it has come. And you got the benefit of that reported into EBITDA, and that percolate to the PAT number. And add to this, the company also enjoyed the lower tax rate regime. So we have a very good decent growth in net profit growth. So I would say this rally is not only supported by liquidity, but by the very strong quarterly result which we saw in Q2 actually. And my sense is that if this kind of earning trajectory continues, we may have the significant upside to the earnings. And similarly, we are in a very benign interest rate scenario. You know that today our one-year FD rate by more promise have come down to 4.9%, close to 3.4%. So its scenario is also helping cost. Add to this from the overseas side. Now, US this year is having 18% fiscal deficit, despite adding more stimulus. If they add more stimulus, the number can be higher. And generally, what we have seen this rule book, whenever US had a higher fiscal deficit, it has always followed by the dollar depreciation, whether in 2007 or it is in 2012. So it will impact on to the emerging market, and daily buyer to the tune of 5,000 crores. And in October whole, they put around $1.5 billion in couple of days. In the month of November, we have already crossed over $3.5 billion. So we are seeing the good inflow traction into the EM, including India. And so the liquidity and flows are good. Quarterly result was really encouraging. So this augur really well. Now we have to only see the sustainability of this rally. My sense is that our 10-year GSEC has a average in the last 10 years was 7.39%. And today GSEC is at 5.9%. So you can say that you can justify 15 to 20% higher valuation. Most of the straits is at around 660 odd EPS for FY22. And if you get 17.8 was the last 10-year average, so you can justify around 20 or so. So there is some upside to the market, subject to the earnings really comes in. Earnings major contribution would be from financial, then Tata Motor, particularly, and then normalcy in profitability from other sector. So this is there now. My then coming to few thing. I'll just highlight few outlook and what has happened in the sector. The cement has the best ever result we have seen across, and so whether it is Southern India, Northern India, from the companies, led by lower fuel prices, because coal prices touched a multi-year low, at least a decadal low, and which benefited the companies to reduce the power and fuel cost. And also in this, the retail sales were higher than the institutional sales, so which has also boosted the profitability of the companies. Then I'll just touch upon IT sector. IT companies benefited from the cross-currency gains because Euro and GBP appreciated in the last quarter, and rupee also had a weaker bias. So the combination, but primarily the cross-currency benefit was more prevalent, and then they were helped by lower visa cost, travel cost, because work from home helped them to boost the profitability. So that helped the IT industry. Third is in the pharma sector. The pharma really got benefited from the stocking by even individual on the fear of COVID, and also supported by lower benign input prices and lower marketing and promotional expenses. So you had the best of all coming through pharma sector in Q2. So you got the benefit of that. Now, I take through some of the. So in the financial sector, they also benefited, primarily because of lower cost of deposit. Though the credit offtake was only sub 6%, so the retail sales were higher, where the margins were relatively high. And in this quarter, because of RBI, RBI directive to the banks, they have not booked additional NPA till the court ruling is awaited. So because of this, the NPA formation was also lower, and benefited from the lower deposit cost. That is what reported, and retail sales were high, disbursement were higher. So that is really helped. And then in the auto sector, we have seen the auto industry did well because of lower input prices. So margins and profitability was quite strong, especially in passenger vehicle and tractor segment. And then coming to the steel industry, did very well because of rising prices by around 5,000 rupees per ton, and lower coal prices, which benefited the steel industry. And then I just take you through the specialty chemical side. Now we are seeing some of the picking of profit, barring some of the good pockets of still good growth in some companies, but it's not broad based. So this is a broad substance on the sectoral outlook. And now I'll take through my fund, which is HDFC Growth Opportunity Fund, and then HDFC Focus Fund. And I manage also HDFC Equity Savings Fund. So HDFC Growth Opportunity Fund, it's a diversified large and mid cap fund. So we need not to do any changes, as per the mandate. So in this, I hold a combination of growth and value stock, primarily more a growth-driven strategy. So this fund, had a higher weightage to oil and gas and infrastructure-related stock. So that has impacted the performance, but I'm very confident that things will normalize and things will start looking great. I have some observation which is my own on my portfolio, is that some of these sectors really get impacted very well, very high, when Government of India's fiscal deficit turns very ugly and you have higher receivables issues and all. Because in after FY18, what has happened? The government fiscal deficit started inching up in FY19, 20, and even in FY21. You know that this is the worst year. We may have, anywhere between 10 to 12% fiscal deficit in combining with the state government fiscal. So this will be the worst year. So whenever the fiscal goes bad, this capital intensive businesses, the receivable issues comes and all. So this sector underperform. So my sense is that the worst of that is behind us. Because in the month of September and October, both months, we have seen a very decent recovery in GST collection. And if it continues, things will look really better in FY22. Even, there is a possibility that COVID side, we may have some breakthrough. And also now, in India, mortality rate is lower, and also now, new infection rates are still under control. So if it continues, believe me, the fund will have a better time. And I really believe that valuation normalization will happen in the infra, capital goods, oil and gas sector, because they have been turned down very badly. They are a great business available at a very minimal valuation because of growth slowdown, which we have seen. Because that this year, anywhere between -6 to -12%. This is a wide range of GDP growth estimate, because October growth has really surprised everyone. So if it continues, we may have a very lower GDP growth slowdown than the feared one of 10-11%, which was estimated. So things will look good. And HDFC Growth Opportunity Fund is a combination of growth and value, and well-diversified fund should benefit for sure to the existing investor and to the new investor. That is my feeling. On HDFC Focus Fund, it's a 30 stock fund, and this fund has a very high exposure to oil and gas, infrastructure, and defense-related PSUs. So which really got impacted very badly, unnecessarily, because of growth slowdown and other receivable issues. So this will also normalize. And what I can assure you to all my investors, that going forward now, we'll have much more diversified portfolio. I am waiting for normalization in earnings and normalization in valuation in some of the sectors to happen, and then I can churn and make it much more diversified, so that we will not have a severe pressure of underperformance, because India is a one market which I always jokingly say it disappoints both optimists and pessimists. So here it is better to have a more diversified portfolio, because some days something works which is very difficult to predict very fast. You know that how rally these days are so fast. Till February, March 2020, pharma was the biggest laggard for the last 5 years, and in 6 months you saw pharma index itself has almost doubled actually, right? So for a fund manager, it is not that easy to take a call very fast. So what I have analyzed, whenever you find a good company, you try to diversify it, and it will really play out well. Like some of the fund managers takes very extreme call, going to zero on IT or very high on IT, one extreme to another extreme also, that suffers very badly. So what I would assure you, that we'll have a more balanced, diversified portfolio strategy, so that we can have better consistent performance in the years to come. What I can assure you, that HDFC Fund as a fund house, we have a very great research team. a very strong analyst team which gives us very good input. And if I do my job properly and do the portfolio diversification properly, I hope performance should really be improved, and it may remain consistent over time. So this is from my side, and now I open the floor for any questions from your side.
Thank you, Gopal, for the summary view of the markets, and also clearly, speaking about the fund positioning. Sure, there are a few questions between myself and Jagannathan. We will pose, ask these questions. Request the participants to post your questions in your link where you can, so that if you have any questions on the funds that we just now discussed, or on the markets, we will ask on your behalf. One of the first questions which I'm coming across is in a query in terms of what is your view on small and mid caps, since they don't seem to have been performing the way the broader market has been. So what is your view on that, and what should somebody advise their investors?
So I just share with you that small and mid cap as a segment should also benefit once the economic activity recovers to a totally normalized level. Today we are at almost at 94 to 96% economic activity level, and they will also benefit from lower interest costs. So once who has investment in this category should remain invested. This is my very personal view, because now large cap has rallied. The small and mid cap have now at some discount to the large cap. So definitely people should remain invested into mid and small cap. That is clearly, I would say that there should be some money allocated towards that. And just to share with you, once the economic activity normalizes, so the real benefit comes to small cap and mid cap. So the only fear I have, which I share with you, that capital investment, capital investment, at least for next 2 years, I really see, not a good sign, because of COVID, the companies have spare capacity and they don't want to commit much money until unless, let's say, you are in a specific business where things are really good. But on a broader side, you will have lower investment. But what I can share with you that mid and small cap has really now at discount, so one can have some allocation towards there.
There is this question about the current, particularly the very recent. We are talking about just about the week's performance of the market seem to be driven by the US results, or also of maybe the Bihar. So, are we talking about markets? Are fundamentals of the market really showing promise to hold such kind of a rally, or what could, or is it a very short term? How do you see this kind of market performance being sustained, say over the next, at least in the near term, or the next 6 months, because the fundamental in terms of results aren't that very encouraging and aren't very broad-based. So people want to know how should one answer queries with regard to the market performance in the near term, if there is any view that you can have on near-term markets.
See, what I can say, Srikanth, with confidence, that this quarterly result season was very promising. So what has happened, despite some volatility we saw in overseas market, so we did well because the result season really was encouraging, and it supports the market on the downside. That is one positive. And second, because of US election, generally, suppose this is a general belief that if the Democrats generally believes in infrastructure spending, and while the Republicans believes in tax cut, so if Democrats comes into the power, then you may have more infrastructure spending actually. That's a belief, and that is historically they have shown. So if that happens, it will be much more. Then what happen? It will immediately lead to some of the higher bond yield in USA. Then what happen? They will also look to it may lead to some of the growth related stock, the value stock start performing, because infrastructure spending, if it happens, it will be broad based rally in the market. So we are also very keenly watching on the development on US side, because the Democrat policy is more on infra spending. That is one. And if there is something wrong also, what we are seeing, this in India itself now the growth is coming back. And if there is no second or third wave of COVID related cases, then what I really feel, with such a lower interest rate in India and improved earning outlook, so the market can correct, but you can't fear. One should not fear of a very big cut in the market.
Yeah. And on the sectors, there is concern or other inquiry with regard to know your views on what about PSUs standalone and what about financial sector, that is including banks. So what's your view on these two? How would you take a view on the PSUs, and what's your view on financial sector?
So Srikanth, let me tell you, first of all, I don't find any difference between PSU and private, because the company works on their business fundamental. What I can share with you, market is a slave of earning. So if there is a earning growth, and also there is a proper management of cash flows, I assure you this both are necessary and essential condition for market to perform, and nobody in the marketplace will leave these two necessary and sufficient condition. So what we have seen, as I mentioned to you, after FY18, our fiscal deficit started increasing and receivable issues came, and also led to multiply this problem. And you saw some of these capital intensive businesses which are primarily into public sector enterprises when you saw them. What I am foreseeing, the way dollar index, if it depreciate, the way it has depreciated from 107 to 92.2 today. So it is to capital flows and risk on rally starts, and you saw the recovery. And India, a good part is that September and October tax collection number, especially on GST side, was very encouraging. So if this continue, so you may see the broad-based rally in the market. On the financial side, what I will say, even if let's say 3 to 4% slippage plus the NPA, which is likely to be there in the system, based on our various interaction and quarterly results shown by the management. So by December, we'll have the clear picture on slippage and restructuring, because as per the RBI mandate, everything got over by August, and still the case is on. So by December quarter, we'll have the real good picture, clarity on the restructuring plus NPA in the banking system. And based on the commentary of various management, they are confident that this number will be sub 3 to 4%. And what I can say, that pre-provisioning operating profit to the loan book of most of the private sector bank is upward of 3%. Okay, so even, and that this profit, this loss, this credit cost provision will linger over 2 years. So what I can say, even in the stress case scenario, they will report profit and book value will rise, even in the worst case scenario. It will not be the case what happened in 9, 10, and 11, where like you had a big corporate NPA and our NPA level moved up by 10% of the system. So this time we are getting feeler that it will not increase by more than 3 to 4%. Even in the bad case scenario, and banks have much more profit levers than it was in the past. So in both the years they will report profit, book value will go up. So there can be some correction in the banking stock, but what I can say that there is no case of big worry on the banking sector actually. And you know that from 1st September, this sector has given more than 20% return, right? Because of what I am sharing with you is actually market thought of it in the quarterly result. So, so this fear reduced and you saw the movement in stock price. So, but what I would say, the real verdict will come by December quarterly result. So, if things are not bad, you will have much more upside.
The next question is with regard to equity savings fund, where one of our participants has asked the question saying that the equity savings fund has shown performance pickup in the last 6 months, whereas the similar is not being seen in Focus 30. What are your comments with regard to that difference in kind of one kind of a fund showing performance pickup, whereas the other is not? And so how should they position, particularly again Focus 30, for those clients who look forward for a slightly aggressive portfolio?
No, see, I am very sure that there is no reason why Focus 30 fund performance will not pick up. See, in this fund, very clearly what has happened, I had the large exposure to oil PSUs, which got battered for no reason. And I really feel there is a lot of value. And now you can see in the last 7-8 days, the market has already started, appreciating this. And they are up by around 20% from the lows, right? So that is so. This clear thought process that there is a value in this stock. Okay, so I'm very confident that the portfolio positioning is not bad. And as I told Srikant, I will really diversify the portfolio in the times to come once the normalization in valuation comes. So I will assure to the investor also that will make it much more diversified and much more consistent than you are seeing today. I will never comment on past because it was not me, but I will take all the responsibility of the fund performance.
The comment, also the request is on equity savings fund, the recent performance pickup, and also what is the outlook for that fund? I mean, in terms of what that they positioned.
Yeah, see, in equity savings fund also, a few things I would really do, which will help investor over years, is that, I know that equity savings investors are ultra conservative investor. So I will make it much more diversified portfolio than what you are seeing it today. Okay. You got a point. So, and it will be like a large and mid cap category, mid cap. So that, the volatility in the fund has to be reduced. That is my top priority in the equity saving fund. But currently, what portfolio I have, I still feel there is some room left, and then I will make it much more diversified. So please keep faith on the fund. And you had gone through the pain, and now don't leave it because last 3 years, because of the changes, challenging macro, you had an impact on the fund, and now you have that. I really feel, I may be wrong, but I really feel the next 2 years are going to be better for us because we are in a benign oil and gas scenario. Price scenario, fiscal deficit will be much better than what we are today. we are in a low interest rate scenario, Indian government is now controlling both the houses, right? So the policy making will be much more easier, and valuation in some of the sectors have really got beaten down. So I really feel there is a good upside.
Right, there are a few more questions. I'll ask one last question and hand over then the questions to be taken up by Jagan to conclude the call. The one question is that how would you talk about value style performing growth style? Is that something that is likely to happen, or what is your views with regard to the one style versus the other? And do you see that we are somewhere around the turnaround? That's one of the questions. I don't think so we can now change anything. I've been checking, but you may please continue, and maybe for the next call we could be.
Yeah. Okay, so Srikant, first of all, every fund manager has their own style of, and there are 100 ways of making money into equity market. So some may use value, some may use growth, some may be very opportunistic, and some may be momentum driven. You don't know. Like everybody has a different style of creating wealth, but and it depends on individual, right? How do they want to invest in the market? Generally, this is my observation that the every style work at a different time frame, and but ultimately your conviction on the style is more important. If a manager is very convinced on the style, and one should always remain glued to this, because if you flip flop, then it creates much more problem, right? So if you are comfortable with whatever style, one should stick to it, and it may play out over a period of time. So what I can say, the last 3 years were really very challenging. So what happened? People, everybody has more short-term memory than long-term memory. So the short-term really, overtakes the long-term. So that is why people feel one style is good or another is bad. But what I have seen over cycle, there is always time for each kind of style of investing, right? So, right. So you have a great player like VVS Lakshman also. You have player like Rahul Dravid also, and you had a player like Sachin Tendulkar also. So everybody did well in different time frame, or sometime at the same time frame also, right? So what I feel that last 3 years was really challenging. So don't bother too much on this. What I feel that value style also works over a period of time. So certainly mean reversion should happen in the next couple of years. So this is what it is. Second question you asked on?
No, I was just mentioning about the audio quality. Second question, I think Jagan will take up. There are a few questions related to
Jagan, please.
I think Jagan, you
thank you. Yes. There are many questions which has come on the to help me summarize with the expected lower inflation and the low interest rate regime. Now, with most of them kind of stepping away from the fixed income when they're looking at the market allocation, most of the questions comes on what asset allocation would you recommend a client now? Market has come back to all-time peak. What kind of asset allocation should we tell the clients if somebody wants to construct a 3 to 5 year asset allocation?
Though I'm not the right guy to answer on asset allocation side because I am not a cross asset expert. Generally as an observant into the marketplace, what I can share that equity as an asset class, is quite interesting at this point of time because the earning growth recovery is coming. And if we see the normalization in economic activity, if there is no second second wave or third wave, then definitely, let's say this year we may have anywhere between -6 to -11% GDP growth rate. Next year will be certainly positive GDP growth rate in FY20. GDP growth rate similarly on normalization in corporate earning, and the valuation can remain high because of attractiveness of India and lower interest rate regime actually. So that makes me constructive on equity as an asset class, and then certainly one should have some allocation towards gold, but I am not an expert on this. But this is general belief, whenever there is a money printing is on, there is an expansion in Fed balance sheet, one should have some allocation towards gold. This is the normal wisdom I have. And as the US has this year 18% fiscal deficit so far, and if they come up with another round of stimulus, it can another add to fiscal deficit. So that gives some allocation towards gold. On fixed income, I will not comment because my knowledge is limited.
You have, in fact, in the earlier questions, extensively covered the broader outlook on Focus 30. People who have been tracking your fund management for long term, if they have to look at a 5-year view on a Focus 30, what kind of top sector would they look for in the portfolio construct? You did mention that at an appropriate valuation, you look at portfolio reconstruct. But from a long-term perspective, what is that Focus 30 top 5 sectors would be to look forward?
Okay, so I'll be certainly be constructive on financial in India, because financial is really, blood. Liquidity is the blood, right, which flows into the body, and without liquidity, nothing will happen. So the financial will remain one of the strong sector in the fund. Second, I will be always constructive on consumption-related theme in the portfolio, because India is a young country and is still, we are on a growth phase. So consumption-related theme, whether it is a staple, durable, automobile, will be a part of it. Then I find, very interesting thing. If really infrastructure investment comes back and US-China relation becomes normalized, then, some of the beta names into the metals, the exports, opportunity in textile and other can also be a great opportunity, right? And third, India is also trying to become very strong in Atmanirbhar. So chemical industry and pharmaceutical industry can always do very well, because people are also looking for another level of sourcing after China. So we can do well. So there I am constructive. And, so these are my real thing. And what I can share with you, that in next couple of years, I really feel market should be much more broad-based rather than narrow, because what I feel, we are coming from a very low growth phase. You see, even before COVID, we were from 7% odd growth, we came to 4.2% in last quarter, right? So once the normalization in activity comes, just let me give you one very clear example. Today, now your home loan rate is sub 6.9%, which is lower than PPF rate. What I have seen in the past, whenever home loan rate is lower than PPF rate, generally housing sector does well. And if housing does well, that in housing construction, 84 agencies are involved, right? Tiles, paint, truckers, that pipe, plumbing, you got the point, architecture, everything. 84 agencies are involved in housing sector. It has a very multiplier effect on economy. So this lower interest rate improves the affordability of people. So I'm really very positive this kind of scenario, Goldilocks situation, continues for a couple of years actually.
Hello.
Yes, please.
In extension of this, in the same, considering your investment style, now with this low interest rate regime, there are many participants who are from the B30 location, which is tier 2 locations.
Right.
On the equity savings, they wish to going forward. What kind of risk management, more from a perspective of, since it's a controlled equity exposure, from a positioning perspective, is there any differential fund management style you would use to this fund than the past? How should they look at the equity?
Yes, no, that's a good question, Jagan. What I can assure you that my first endeavor, because I know the pain, and the expectation of the equity savings investor, they want less volatile and reasonable return from the fund, not very high return. So their risk appetite is also low. So I'll try to make it much more diversified portfolio. That is the important point, and that will be the real change in the portfolio. And I'll be having the quality companies. Quality means the market leader or the business leader in every segment. I'll try to have in my portfolio.
Wonderful, wonderful. I guess thank you so much. I think extensively you had a fantastic shared insight on markets, global markets, interest rate outlook. What should be the expectation on earnings? I think in this call, you have also given a lot of conviction on way forward for all the funds you have managed. With this, we have covered most of the questions which you have asked. Srikanth, do you have any questions to add?
Yeah, more than a question, I think there have been quite a few questions which have been posted with regard to equity fund and what would happen. Well, I think everybody is aware that SEBI has introduced another segment called as a flexi cap. We are in the process of taking call on in terms of where and how, what kind of positioning this fund will be done. So we do have possibilities of managing the fund in the same style that it was there, and yet not change the characteristic of the style. So that much is something that I can tell. But we are yet to will definitely come out with specific on what we are doing with regard to HDFC Equity Fund. That is one. Second is that there have been some questions related to some of our other flagship funds, the equity top or balance advantage. I can, as Mr. Gopal Agarwal was just explaining, that the valuations of some of these sectors have come down quite significantly without any particular reason, and more so in the last 6 months, while some of the sort of, you can say, growth-oriented sectors or consumer sectors have still done well, but many have not done well. We see a different possibility of the portfolio to perform to its true potential. And while we'll have an elaborate call with Mr. Prashant Jain soon on that to explain the positioning of this fund, the portfolio, what's happening, and why one should consider this fund to stay invested, or also to add the reason, because while whatever funds have done well, we have seen that sectors keep changing, sector shifts keep happening, and whenever there are extremely rich valuations in some, the next cycle will always round the corner. So I think we'll have to just wait for it. But however, we'll have a longer call on that to explain that. So there is, in a brief, I can mention about these two queries which is being posted by a couple of our participants. And I guess you have also, Gopal, thank you for your time. There has been another last question is on the IT sector with new technologies and all coming in. So how would you view IT sector as to be considered in the portfolio? And then we can conclude. Is there any question, Jagan?
No.
Yes, Srikanth, I will always keep IT in my portfolio.
Okay. Yeah. Thank you, Gopal, and thank you, participants, for logging in and sparing us your time to hear us out. I'm sure our team will be again in touch with you and to give any further information on portfolio and of our funds. Thank you all. Thank you, Gopal, and we can conclude this. Thank you, Jay.
Thank you.
And happy
advance Diwali wishes.
Yeah. Wishing all participants a very, very happy Diwali.
Thank you all. Thanks for the participation. Thank you, Sri.